So basically, the big story is the same. The Fed is still raising rates. As you can see, they have not raised rates up to the neutral level. In fact, they're way behind the neutral level. So we still have big rate hikes coming. Their markets are trying to figure out whether it's going to be another 75 basis point hike at the end of this month, or just a 50 basis point hike, but you probably have multiple 50 basis point hikes still ahead. That generally provides a pretty big headwind for risk on assets, and so that's likely to obtain here. Basically, the Fed is changed its focus from artificially stimulating asset prices to fighting inflation. And so with that being the case, the Fed put is not really on asset classes right now, as it has been for many years, and the Fed is likely to continue tightening until we get some kind of something that could make them shift. Talk about a number of different things. Could be a financial accident. Probably that's the most likely because we're so heavily indebted. There's so many areas that are just overdone that raising rates, something will break. And it's quite common for the Fed to have set on a path of raising rates beyond a neutral rate that it puts way above, and then it tightens and tightens, and then something breaks, and that accident puts fear in the hearts of central bankers, and they shift policy. So that's certainly one policy to watch for a financial accident, something in Japan, something in Europe, something in the emerging markets, or something in corporate America that's really big, some major hedge fund. Those are types of things. 1998 LTCM blew up when the Russian ruble devalued. So there's all kinds of things like that that can happen, and we have to watch out for those and realize that those can often prematurely end the hiking plan. They're also talking about demand destruction in either the labor market or the housing market. And what that means is they're going to be tightening until housing prices turn down on a year-over-year basis. There's some reasons why normally when you get housing prices rising as much as we do, you have a big supply pipeline builds up, and then supply builds up, and at the same time the demand cools down, you have this huge supply, and that really hits prices. We haven't really had that huge supply come on, might make it difficult for a year-over-year decline in housing when we're still in a shortage. Unemployment rising by about 2%. So we still, again on Friday, still had a fairly strong NFP report. That gives a green light to the Fed to keep hiking. That's a long way from unemployment rising 2% from current levels. If the CPI falls back down 2.5 or 3, something in that, and falls significantly, the Fed could begin to take its foot off the brake. If the Fed, just kept unwinding its balance sheet and got to its target level, that might change policy. It's very unlikely. If the stock market falls by over 40% and scares them that they're starting to get a deflationary spiral, that's something that could shift policy. We're not there yet. And then if the economy declines so severely that they get concerned that they've started a self-reinforcing negative feedback loop like they did in 2008 when they let some of the big investment banks fail, then that's likely to scare them into shift policy. So really, we're kind of in a period where they're hiking aggressively until we get something along these lines that will shift policy. It's likely to be a painful process as they basically unwind a lot of the leverage that they built up until we get one of these developments. Okay, so then what the big shift from June is from May to June and the beginning of July here is that over the course of the month, we've had a significant decline in a lot of different macro indicators that suggest the risk of recession now is rising fairly substantially. It's quite possible that they will declare recession at the end of this month when the second quarter GDP comes out. Right now, as you can see, the GDP now, which is the best of any of these estimates that second quarter GDP is going to be negative, slightly under 1% down. That would be 2 quarters of negative GDP. Probably they would declare a recession, although there's likely to be a lot of political pressure on the people that the committee that declares recession not to do it in this election period. But we have key point here is recession risks are really high and they're continuing to go up, and we could be in recession already. Also, we have the 2-10 yield curve inverting. Again, this is the second inversion of the year. We had one in April, bounced back, didn't get above this key 0.5% yield curve level, came back down. Now we're inverting again. What that does is it means this whole time, really kind of when you're falling below 0.5, you're in a period where that just doesn't make that much sense for banks to lend. They don't have a good margin. They borrow short and lend long, and when there's no profit to that, they're not going to loan. We'll see that coming up retroactively when we look at lending, but what we can see already that is these overnight reverse repos that banks do, where they basically lend their bonds, keep them at the Fed and get a little bit of extra yield. These are going nuts, really exploding. And what that tends to mean is that banks aren't lending customers, they're lending to the Fed. So we can already see this break on lending is starting to materialize. So we talk a lot about whether we're going to have recession or not. It's a very important question. So here the bottom panel from Lombard, this just sort of shows you in big declines of like 17% or more in the market. Here's where we are in white, and here's two paths. This sort of neon green solid line is if there's a recession, and you can see we have a long way to go for a long time and a lot more downside typically on average if we get a recession. This dotted line is a major correction without a recession. So you can see that we're getting pretty close to a bottom zone. The average is about a 23.5% decline, and we're pretty close to that if we're going to have a soft landing and avoid a recession. But if we have recession, we probably have longer and much more to go on the downside. That's why it's an important point. And then the other point we talked about last month, how peaks in inflation tends to see stocks pick up. But what I want you to understand here is these two divergent paths that we talked about last time. Here, this is from Goldman, and this shows here's the peak in inflation. And if you don't have a recession following that, you get a nearly immediate response from stocks sharply higher. But in the instances where you also have a recession following, you still have ways to go. So you can see whether we peak in inflation or not. Whether we go into recession is a big, big question, and it will have a lot to do with how much further we have on the downside. And right now, the odds of recession are quite high. So we've got a lot of different recession warning signs over the last month in particular. Here's a macro one, real manufacturing and trade sales. Just notice that we haven't really fallen 2.5% below zero anytime except just before or during a recession since World War II. And we have now fallen by more than that. So there's some indications that we're essentially already in recession. Base metals in the markets, we talked about how copper falling below 4 last month, and it did this month, and you can see it's followed through, and the whole base metal complex has followed through on the downside a lot that typically occurs prior to recession. So we've got some markets telling us that Dr. Copper saying there's real recession risk here or extreme deceleration. And then commodities as a whole. Take a look, this is a good chart. Basically, this is the year over year, or the percent change for 20 days in commodity indexes. What I want you to see is, first of all, this is since the Great Depression, this is the third largest 20-day decline in the commodity index that we've had since 2007 and since 2020, and we're in the third largest. and all the other that were nearly this large have all been prior to recession. So the commodity markets are starting to say, yeah, we've got a big potential for recession here as well. So one of the things that hasn't broken down that we've been watching, we continue to watch, is the oil market. And so energy has fallen more than oil. Energy stocks are kind of at an important support level. They've bounced a little bit. If these lows, the 65 level gives way on a closing basis, that's another sort of vote for recession. I also will watch oil. Oil will likely break down if we go into recession and keep going, and it's not just a really short-lived one, but you want to realize that we're in a supply deficit, essentially, where supply is really short for energy, and a lot of energy demand is inelastic. You've got uptrend here and some really major support in BNO. You really have to break that to signal this, and it's possible that we could get a mini recession without this breaking down. So watch energy, XLE stocks in particular for a breakdown next that would confirm recession. And it's possible we could get it in oil, but realize oil's probably going to be the last man standing. All right, we talked about last month how we were bumping up against this long-term, this is really a trend channel that's been underway since the 80s on the monthly chart. And we did hit that 3.4. We went a little bit beyond it, barely for a little bit, and then came right back on the weekly and monthly charts, had reversals back into the range. So we're really kind of backing off of this resistance level that we've been talking about. Now we're trying to figure out how much of a back off we get. If indeed we're starting into recession, bonds could actually go up and rates could come down significantly. We closed below 2.7 under this recent stuff in TNX. That is the equivalent, and here's TLT, which moves the opposite direction, which is the long bond. You can see TLT is making a head and shoulders bottom potentially. We close over 120. That suggests that there's going to be more upside for bonds, more downside for interest rates, and that's probably a recession scenario. If you have TBF, from which we've had for a long time, as kind of a macro play for higher interest rates, you close above this 120 on TLT, we'd probably take profits temporarily. Conversely, if we don't do that and we close below 107.50, we would add to that position. If you don't have TBF positions, that would be a time to buy them with protected stops above the equivalent of the highs that you make in this TLT rally. Okay, taking a look at the S&P, we can see that while we started off fairly strong and got a few thrusts on the first stage of this rally off these lows, and these lows came without the necessary divergence. You can see there's kind of a trend channel they're bouncing off of, but the last phase over the last week and a half has been on very low volume. That's not really what you want to see for continuation. Normally, we get at least 12 or the 50 different kinds of demand thrusts that we watch out for. We've gotten about 3. So that's not near the 12 that we normally get in a sustained rally. So we don't see this as anything more than a bear rally. There's resistance up here at about 40.15 that we watch. There's this downtrend channel, 42.20, kind of where at worst case it should get. But somewhere around here, if we start getting 80% down volume again, that would be a signal that we're likely headed lower. And if we break these lows, we suggest that's likely to be somewhat of a trap door and could trigger a lot more acceleration to the downside. So capital preservation should continue to be a top priority, remain defensive. If you have negative market strategies like long shorts, those are particularly good in this backdrop. And then we also like sort of macro speculative plays that give you leverage on specific positions. We like shorting emerging market bonds as an example, shorts in the dollar yen and in the long in dollar versus the euro. And some of our long list trades against short list trades, I think, are some of the best trades for this backdrop. You can see in terms of our supply and demand, Nothing's really changed. The supply is still trending higher. Demand is still trying to bottom and kind of in a trading range, but on the wrong side of its moving average. And the net, the spread of the two, is still trending lower. It's below its downtrend channel, below its 200 DMA, and below its 40 DMA, and threatening to break down to new lows. So the intermediate term indicators are still trending lower. So unless we get a very clear demand response that looks very strong, we get a lot of thrusts off of it, we're still, the intermediate term trend appears to be lower. Same thing with the major internals. In this advanced decline line is in a downtrend channel, making lower lows, lower highs, below its 150-day long-term moving average, below its downtrend channel. Same thing with nice cumulative net volume. Same thing with net points, and same thing with the OCO versions of the advanced decline line. All those things are making lower lows, lower highs, below major moving averages, and below downtrend lines, so that their trend is lower, meaning the intermediate term trend continues to look down for stocks. Not getting a lot of thrusts. As we mentioned, we have none on this list off of the recent lows. Usually get a dozen or so in the 50 thrusts that we watch, and we've gotten 3. So unless we get a lot stronger action, this is probably a bear rally that you want to be looking to sell, not something to buy. You can also see from the seasonal pattern, here we are about here. And so we're getting to a point where the S&P tends to peak, and between here and the 25th is where it often peaks. And then after the 25th of July, we have actually one of the stronger seasonals to the downside. That's sort of getting a week or so into the Q2 earnings season. And so it's often a negative. That's often when companies change their year-long guidance. So if there's any problem in the backdrop, that usually develops. So we're coming up to an area where we could have seasonals heading down into October and be setting up for a high at a time when the market could be making a high. Now, there is hope after the election, and you can see that in midterms, even those that had accompanied recession, about 85% of the time the market was sharply higher after with the rally after the November election, and a year later it was up an average of 46.9%. So if we can get a recession declared soon and some downside capitulation and make a low, there is still a decent shot for a fairly strong rally later in the year, and that's one of the scenarios to sort of keep in the back of your mind.